Good afternoon, ladies and gentlemen. Tonight we're going to talk about technical analysis. So we will start after a brief introduction of last Monday. We will start to see a bit more into the details of the maths related to trading. First of all, a question. Are you an investor or a trader? This is pretty important to understand the role of fundamental analysis versus technical analysis. Investor is a person who is buying shares, for example, to keep them for a long time. Why? Normally shares. Because normally we presume that a company like Facebook or Netflix or Zoom or whatever will improve the value of the shares. So we are keen to buy and keep, buy and hold. And normally the project is to hold the shares for a long time. Traders don't care. We buy when we believe that the price is low, and we sell when we believe that the price is high with a margin. And the operations are relatively quickly, from seconds to days. The investor is holding shares, for example, for years, okay? So, and sometimes we are not planning to wait the improvement, the increasing of a value of a currency, because we presume that the currency value, the currency exchange value will decrease, so we sell. And this is something that the investor with share cannot understand from some point of view. So generally speaking, the difference between the investor and the trader is that the investor has a low risk with low profit. The trader has a higher risk, but with a higher profit, okay? When we are doing trading, we have some tools, and those tools are pretty important. Those tools are related to our trading style. The tools are related to the money management, so different, like charting software, different kind of calculators, position size calculators, lot size, market sentiment analysis, economic calendars, or whatever. But one of the most important is the technical analysis. So the technical analysis is a methodology where we study the past market data and primarily the price and the volume. And with this study, we try to forecast the future price direction through statistical methods. So technical analysis, that we will call TA, is fundamental and statistical mathematical method. In other words, technical analysis believe that it's possible to forecast the future price direction analyzing the past movements. Why we try to analyze? Because we have to take the fundamental decision, the operational decision, that is buy something, sell something, or simply wait. What do we analyze? So we analyze normally three parts. The first one is the price trend over time. So what we call the direction, trend up, trend down. And the volume of the contracts in the same time. So this is one of the possible charts that we can have. But anyhow, in this chart, we have the contracts, what we call the volume. The volume means that in this moment, in this peculiar moment, the number of contracts closed was higher, for example, than here. And there is also a third part that is called the analysis of the open interest, the futures, the derivative contracts, the options, but we are not taking care about that in this course. So what we do concretely, we apply mathematical formulas to the past data. So we say that we analyze the graph. Why are we doing that? Because we believe that under the same conditions, the trader's behavior or the operators, so that the market maker's behavior is repetitive. The graph reflects the decision of the operator in the presence of some conditions. So if we see that something is going to happen, probably, if something happened, probably the same condition will cause the price action to occur again. And the behavior of the market makers probably will be the same. If probably is the same, it means that is statistically predictable. So what are you trying to analyze with the technical analysis? Technical analysis is not to identify a trend. To identify a trend is really very, very simple. It's one of the simplest part in technical analysis. What's important is to try to identify trend change, because we know that when the trend will change, so from downtrend to uptrend to downtrend and so on, we will use the information to open a new position or to close an existing position, because the final goal is to maximize the profit. Indicator, so indicator is just one of the tools. So it's what we call indicator is the equivalent of mathematical formulas that we use to analyze the price trend. These formulas were invented by financial experts. Normally we start from Fibonacci in the 12th centuries in Pisa, Munehisa Homma in 18th centuries in Japan, 17th centuries actually, in Japan was the person who invented the Japanese candlestick, Fourier, Wilder, Bollinger, or whatever, there are a lot. These formulas are applied to a specific graph, and the formula show the results on the graph itself. And these formulas are what we call indicators, and we say to apply an indicator to the chart. So let's see, we can have a chart without indicators, what we call the naked chart. The chart may be with a Japanese candlestick or a Western bar, but it's almost the same. They're containing the very same information. And we can apply some indicators. So these are indicators, for example, the MACD or the alligator or whatever. There are also some fancy names indicating the indicators, and there are a lot of indicators, a lot. So it's we can have some indicators that are more visual, some more that are more textual, with providing mathematical information. Okay. Indicators, or indicator in itself is a formula. We take as an example the LWMA indicator. This is a part of the formula. I'm not able at the moment to explain the meaning of all these formula, but it's this formula can be applied to a chart and providing information. But please remember, there are no mathematical formulas capable of predicting the future. So don't believe when you see on YouTube or on internet that with the use of this or that indicator, you can achieve the 100% of results or whatever. It's absolutely unthinkable to be able to determine the exact point of trend change. What's the purpose of TA? It's just to improve the forecasting ability. And to forecast, it does not mean to foresee the future. So how we work, normally we have a group of indicators. The group of indicators agree in one direction, and they will give us an operational signal in order to open or to close a transaction. But remember that indicators always analyze the past. And for this reason, when we see the results of indication, they are also late. about the future. So we say that indicators are lagging because they are measuring something that has already happened. Okay, we will try to use, in our opinion, some indicators that are not lagging but leading. But anyhow, this is a part of the package. So indicators can't be used to foresee the future. The indicators indicate a likely future action because we are talking about a statistic. So the goal, the meaning of the indicators is to improve the trader's performance, generally speaking. The minimum performance is 50%. Why? Because price can go up or can go down. It's like when we play in roulette in the casino, so it's maybe red, maybe black. So it's almost 50-50. Like in the casino where there is the green, in Forex marketing, there is the spread, there are the bank costs, the commission or whatever. So it's not precisely 50%, 50-50, but just to give an idea. The maximum theoretical performance is 100%. The meaning of the indicators is to move the performance to a higher level than 50. When we have a winning ratio bigger than 50%, so maybe also 60%, 51%, doesn't matter, but when it is more than 50%, through a proper money management and risk management, we will be in profit. So how many indicators exist? Has been calculated that in today's market are around 20,000 indicators, roughly. But those indicators belong to 5 categories. And the mathematical formula that are behind those indicators in reality are much, much lesser. So let's say around 100, 150, but with different user interfaces. Are all indicators useful in my trading? Absolutely no. Not because my trading style is different from your trading style. So probably we're going to use different indicators. And again, we have different categories of indicators. So how many indicators do I need? Normally we are using 3, let's say. And some indicators are more useful in order to indicate the entrance, and some other are more useful to indicate the exit from the trade. So what's important is that the indicators in my screen have to belong to different categories. I want to use an example. Consider yourself as the president of the board of directors in a corporation. Okay, so around your table, you decide to have, let's say, 5 directors with you in order to help you to take some important decisions. If you have 5 experts around the table, 5 directors or whatever, it would be pretty stupid to have 5 lawyers or 5 engineers or 5 public relations or 5 financial manager. So all them in the same category, because they can see slightly different the problem from a different point of view, but all of them will agree. So the proper board of director will have 1 lawyer, 1 financial, 1 PR, 1 human resources, 1 of these and 1 of that. Because in this case, maybe that 1 director will say something. When 1 director will say something, another one will have some reasons to say something else. So they are giving informations to the president of the board to take the proper decision. So this is the reason why we don't want to have 100 people around the table to give suggestions, because of course we won't be able to walk. And from another, we choose carefully who will be the director sitting at the board. The opposite of technical analysis is the so-called fundamental analysis. The fundamental analysis is more related to shares, corporations. So it's more the analysis of what Facebook is doing at the moment. What is the plan of Zoom if coronavirus will come with a second wave? Can I believe that according to the balance of the company, the balance sheet of the company, according to the project of the company, the shares value will increase or decrease? So we analyze the basic data of the company, not the history of the company in the market, but the basic data of the company. Sometimes we can apply also the fundamental analysis, not only to corporations, but to government, for example. If I'm analyzing indexes like DAX for German market, I could also doing a kind of analysis. But when we are moving to Forex marketing, there is no real fundamental analysis, if not only some macro values that we call support and resistance, but it's a different point. For you guys that following the course, the academy, remember that I strongly suggest to have a regular mouse in your computer. So also if you're using a notebook, don't use the pad mouse, but have a normal one, because the central wheel in the mouse is pretty important. And remember that we do not invest in hardware because we have an external server in Germany. So all the operations are carried out in the external server. But what's important is to have a good monitor, okay? And that's it. I suggest to open an account in TradingView. TradingView is free of charge if you want, and click on chart. You will have such kind of chart, and try to modify some parameters. Just put any indicators, doesn't matter which one at the moment. Different kind of candles, different kind of time frames, different currency pairs or shares, because technical analysis is not only for Forex market, but is in general is the analysis of the chart. So in the chart, we can have a share, we can have a crude oil, we can have energy, we can have soybeans, doesn't matter. The technical analysis is the analysis of the chart. So enjoy with some experiments on TradingView. Some homeworks for you guys. So Baby Pips. Baby Pips is an excellent website, free of charge, with pretty good, pretty famous education. You can go to Baby Pips education and start from the preschool and follow the first section. This is because, sometimes we are not coming from the same background, so it's better if you follow also some basic definitions in order to have the same vocabulary all together. In the e-learning module, you have the John Murphy. It's an excellent book, a huge one. It's more than 500 pages. It's a classic one. It has been written, the first edition, around the 70s. Please take a look in the first chapter. It's just 20 pages explaining what technical analysis is. If you want to open an account in TradingView, try to open a chart and enjoy that. And then, just for fun, but try to meditate on the first 3 Murphy's Law and how to apply to the Forex trading. Thank you. So I hope you enjoyed. We're going to have the live session in a few minutes. See you later. Bye.